All right, let's continue to take a look at the markets. Our next guest is Eddy Gifford, CFP Wealth Advisor at Tactive. Well, we're looking at the October slide, continues. We get a huge amount of earnings this week, 1/3 of the S&P 500. Tell me a little bit about where we stand in the market right now, your thoughts.
Well, I think that this is a pivotal week. As you said, about 1/3 of the earnings are on the SP 500 are this week, and I think it's really going to be kind of a make or break it situation. I mean, when we look at it from a geopolitical level, we're like, oh my goodness, this doesn't look good, right? And then we look at it even from just like a macro level, inflation, maybe it's come down, but that doesn't mean that things aren't still 30 to 40% more expensive than they were three to 4 years ago. And then couple that with interest rates and the fact that those are elevated, which is also dipping into the everyday consumer's pocketbook. And you have kind of this shaky foundation. And so, what can kind of shore it up would be a good earnings season where we do the opposite of what everybody is fearful of. And everyone is scared right now that things are bent to the place to where there's no coming back. It's going to just break. And so that's kind of the sensitivity right now is have things bent so far that it's going to break, or do we still have one more earnings season that can get us out of this? And so we're cautious. Heading into the end of the year is typically a good quarter, especially in a pre-election year. But there are a lot of things to worry about, and that wall of worry is there, which you could argue is a good thing. But there's enough shakiness to where we could see a trapdoor situation and the market could fall out from underneath us. So it's definitely I think it's a unprecedented time, although it feels eerily similar to 2000. So we'll see.
So at this point now, I think you make a good, you have the big picture and sort of what's going on at this moment. And you mentioned some of the geopolitical risks we're seeing. It's really obviously as watch the yields move higher, right? So the 10%, the 10-year gets to 5%. And markets are selling off. Then that sort of is pulling back. Markets start to take back off. We had the inversion of the yield curve, then the reinversion of the yield curve. What's going on here, and where does it sort of find its footing and sort of stop this back and forth a little bit?
Well, I think the bond market has been trying to tell us something for a long time, and that's that there's a lot of uncertainty out there. And then when you couple that with the fact that the Fed continues to hold strong on the inflation mandate and they're not budging, we don't know what to do, right? But the thing is what we've seen this year is we've seen a couple times where things have gone real bad real fast. And we've seen that flight to safety trade come back with treasuries. And then we've seen treasuries just kind of fall because inflation is going to last forever, right? And then we see it again. And even, Acme came out today and said, hey, like I would think twice about shorting treasuries at this level. And so I think that like we've been trying to find this equilibrium, and we've been trying to get back to like, hey, the 60-40 work again, right? And I think that we may be at that point where at least like there's a flight to safety type scenario again. Although the difference that we have this time compared to all the other times is that Bitcoin has a much higher adoption rate than it did like 3, 4, 5 years ago. And so, the question is the reason Bitcoin's been going up because that's a flight to safety, or is that a risk on trade? And that's the thing that we're trying to decipher. And you look to the Treasury market today, and yields have fallen today. The question is that a sign of, we're back? So there's a lot of stuff to be aware of, and that's why you just have to stay disciplined in what you're doing.
Yeah. Let's get to some of your picks, because as you talk about Ackman and, stepping away from shorting bonds, in the meantime, you're saying maybe short emerging markets. Tell us a little bit about that play.
Yeah, the reality is I don't see the big picture, the macro view really changing much, right? The inflation is still high. We still have geopolitical stress. Energy prices are probably going up. Interest rates are probably staying high in most areas of the world, at least for the foreseeable future, until something absolutely breaks. And because of that, like emerging markets, they don't have like these big mega cap companies that could come back and like save them, so to speak, right? And so if we're just looking at it from just a purely logical standpoint, we think that if you're buying emerging markets, you shouldn't be. You should be going the other direction. And it could provide an effective hedge to a long portfolio too. So you always have to make sure that when you're constructing your portfolio that you've got stuff to offset each other, and this could be a good hedge or this could be a good bet. We'll see how it plays out.
Right, understood. And how about Eli Lilly? Tell me about that one. That's a stock that's been on the rise. Is there still some room to run there?
I think there is, especially if they get the approval for the obesity drug. But and we've got earnings coming out at the end of this month, and if those look good or look better than expected, then yeah, we could definitely run up to 630, 650. Of course, there's a chance that we can be wrong, and that's why we make sure that if anytime we buy a stock, we're going to put in some stops. So we would get rid of half of it at 564. We get rid of the rest of it at 437 is part of our trade management strategy. But you got to take risks, and if you want to get rewards, and we think that Eli Lilly is a good risk, and we're going to manage that accordingly.
Okay. And last but not least, U.S. Treasuries. What are your thoughts on U.S. Treasuries and how to do this?
I think that U.S. Treasuries probably may provide like the most effective hedge over the next 12 to 24 months. The reality is that it could dip a little bit lower, but when you look at it from a long-term standpoint, whether you're looking at the 10-year or the 20-year, yields are roughly at 5%. So if all you did was put that money in there and come back and look at it in, 10 to 15 years, your worst case scenario is going to be a 5% per year return. Now, there's going to be a lot of volatility around that because of the bond market. But the thing I like about bonds in these scenarios is if things do turn and break and we see a flood into treasuries, you get paid in advance, right? Because that 5% per annum that you're expecting over the next 10 years, you get in the next 10 months instead. And then you can go and look for stuff to buy again, and you've got more capital to do it with. So I definitely like treasuries right now. I'd like them a lot more if they're above the 50-day moving average. But you can't get everything you want all the time, right?
Right, I get it, and we hear you. Eddy Gifford, thank you. CFP at Tactive. Thank you, Eddy.